Hi, this is Mike Larson from Money and Markets TV. It seems like this European debt crisis has been going on forever because we keep seeing the same pattern play out over and over again. Crisis, response, disappointment, and then crisis again. First, some event causes the crisis to explode onto the front pages. The prices of bonds and stocks in the affected country or countries tumble and volatility spikes. Second, government officials or central bankers run around like chickens with their heads cut off. They cook up some half-baked plan to calm everyone down and to avoid another Lehman Brothers style collapse. Third, the new plan causes markets to spike momentarily. Stocks go up, volatility goes down. But once the details of the plan start leaking out, investors realize there's no there. The plan is more conceptual than concrete, or it won't work as structured. That leads to disappointment. Fourth, investors realize there simply isn't enough cash floating around anywhere to bail out all the struggling Eurozone countries, including Spain and Italy. So the crisis explodes onto the front pages once again, and we head back down. This pattern seems so familiar, not just because we've seen it over and over again in Europe, but because something similar happened in our own private credit crisis a few years ago. Some institution like Bear Stearns or Fannie Mae would teeter and the markets would freak out. Government officials would intervene with the bailout plan, and everyone would calm down for a while. But because the underlying problems weren't dealt with, the whole sorry process would play out again a few months later. Eventually, the crisis blew up for good when Lehman Brothers was allowed to declare bankruptcy in September of 2008. That caused a massive spike in volatility and a corresponding collapse in financial markets. But government officials drew the wrong lesson from the experience, that no large institution should ever be allowed to fail, that they should just throw more money at the problem, moral hazard be damned. Clearly, European officials are following the same playbook. They bailed out Greece twice. They bailed out Irish banks and the Portuguese government. And then a week ago, they pledged 100 billion euros to shore up Spanish banks. They're so focused on preventing another Lehman moment in the short term, they're ignoring the long-term consequences. But folks, you can't prevent the inevitable forever. The only real solution is to let Greece and other struggling nations repudiate their debts and exit the euro, and let vulnerable financial institutions fail. It'll be ugly in the short term, I admit that. Markets will fall and volatility will surge, but we'll also clear up unpayable debts off government balance sheets, prevent zombie banks from dragging down healthier institutions, and allow the long-term healing process to get underway. However, I have no confidence in politicians to make that brave decision anytime soon. So as investors, we have no choice but to play this cycle. First, sell stocks and other risk assets during times of calm, or buy inverse ETFs or put options if you're more aggressive. Second, take profits on those downside hedges whenever we get a big crisis-driven swoon. You could even add some cheap upside plays to ride the inevitable bailout rally. And third, once those rallies peter out, repeat step one. That way you'll be positioned for the next crisis-driven collapse. That's what I've been doing and will continue to do so until the end game finally arrives. Only then, when the repudiation, the failures, and the big collapses occur, will I do some longer-term bottom fishing. Because only then will assets be truly cheap for more than a trade. I'm Mike Larson for Money and Markets TV. Thanks for watching.